Now, if you trade Monday, Tuesday, or Wednesday during FOMC week, you're probably bleeding money and don't even realize it. And if you remove what I'm about to teach you from your trading strategy, your win rate will likely increase by several %. So this is the week where disciplined traders do something different. And everyone else, the gamblers, they donate their accounts back to the market. So in this video, I'm going to show you exactly when not to trade during FOMC week, the only setups that are actually worth touching, and how to avoid the slow bleed that wipes out most traders before the news even hits on Wednesday afternoon. Now, I'm Brett James, and no, I don't have a Lambo. I'm just a family man focused on stacking small, repeatable gains and executing them well. My claim to fame is that I still have my very first funded account a year and a half later. And in fact, I actually have 8 of my 9 first funded legacy accounts to this day. Now, enough of an intro. Let's get into it, traders. So today, right here, what we have is Monday of FOMC week. And to start off with maybe a little bit of a story and to fill you in, if you don't know already, you can go to forexfactory.com. You can look at the news for the week. And what we have is FOMC on Wednesday. And this is super important for trading Monday and Tuesday. FOMC happens not quite once a month, but it makes a significant impact on the entire week. Now, what do I mean by that? Well, look at the price action here today. This is the kind of day where previously in my trading, maybe last year, I would wreck myself on a day like today. And I didn't take any trades today. Here's my P&L calendar. We can see it's, resynced to right now. No trades today on any of my funded accounts. And what would typically happen on a day like today, especially as an ICT trader, like I looked at this setup this morning, and this stuff was like enticing. And yeah, everything I was looking for. It was a stop hunt and a manipulation on sell side down in here. Here was an inversion, a close above, and let's say you took this close right here above this inversion, and you would get stopped out on this one. Or if you took this inversion here, there was a no close above on that inversion, so you took this breaker right here, and same kind of thing. It just didn't want to go. And it looked perfect. It looked like we had these equal highs up in here, relative equal highs. We had this trend line liquidity. There's Asia session has equal highs up in here. And no matter what you did, if you were on the long side, it just wouldn't go. And similarly for the shorts, not that there wasn't some small little 30-second plays in here that one could have gotten away with. But what I'm saying here is by and large, if you're trading on the 1 minute, 2 minute, 5 minute time frame, nothing happened. It just chewed up traders. And maybe you take a loss or 2 or 3 or 4, and you just keep thinking, like on this right here, like, oh, look at this. It just swept liquidity down in here. Here's an inversion, and it's going to go this time. I know it, and you take a long somewhere in here, and it just doesn't. This is the kind of price action that fools traders into wrecking accounts. And this is the kind of stuff that would have chewed me up in the past, but no longer does anymore. And so what I want to share with you here and what this means for you. And I'm going to share this in a couple of different ways, both from a technical perspective and rules you can implement into your strategy that'll help improve your win rate, but also things that'll improve your confidence, reduce your stress, preserve your capital. And there's a few things in here that I'm going to teach that nobody really likes, but it's actually the stuff that I feel has made me the most consistent in trading. And it's unfortunate. People just want to make the strategy change and get a bajillion % win rate. But that's not what actually makes traders, because you can have a success with any strategy. So why is that? It's not like any one strategy is much better than another. It's the trader behind the strategy. So let's dive in. I want to show you something first here. Now, the first thing. So this is my April P&L. One thing I really want to point out here, and this is one thing I really want to drive home, is look at this. So the first week was basically break even. I think there was a couple trades Monday, Tuesday from April, but they were essentially break even. Yeah, so nothing really there. But what I want to show you on these accounts that I'm trading currently is this first week was a slightly red week, whereas this week here had significant gains, and then this week here was moderate. And one of the things that took me a long time to realize in my trading, and it wasn't until I had years of data to look at and see that there's a pattern here, to see that there are some weeks where it's all about making gains and some weeks where it's about capital preservation. And now FOMC week, it's all about capital preservation. That means we need to change how we're trading. Let's look into the data, and then I'm going to show you some examples, and we're going to get into like when I would consider trading on FOMC week and when I'm not going to trade on FOMC week. So let me change screens over here. I'm going to move some stuff around. So I pulled together some data. I looked at all of the FOMC weeks from the past, 1, 2, 3, 4, 5, 6 of them, and let me see if I can zoom in on this a little bit for you. So should you trade pre-FOMC? And what I mean by that is Monday, Tuesday, Wednesday AM. And in looking at all of this data, ultimately what the ones and zeros, the red and the green and the yellow mean is, was this a good day to trade? So in the case of 3-14 of 2026, Monday wasn't a good day to trade, and nor was Tuesday and nor was Wednesday. You can see my notes from the week. AM had no setups, mostly seek and destroy. PM was wicky and high resistance liquidity sideways. So there really wasn't even anything to do on this FOMC Monday through Wednesday. On January, what we can see here is Wednesday, there wasn't anything. Tuesday, there actually was one A+ setup. Monday, nothing. And then just looking back, you see the pattern. We had this week in particular where it was actually kind of nice, but then October and then September, you can just see it wasn't even worth your time. So what does this mean? This means to me that the Monday, Tuesday, and Wednesday AM are nearly not even worth your time in front of the charts, especially with a funded account. And maybe if you wanted to trade an eval, if you're just trying to stack accounts, that's cool. Because obviously what you can see is there are some occasional setups within this. But ultimately, if you can imagine, with your strategy having a particular win rate, call it 65%, do you think your strategy is going to have a 65% win rate on these days? It's probably not. It's probably going to have more like a 40% win rate or something like that. I mean, I'm obviously making these numbers up, but I think that you get the idea. The idea here being that in low probability conditions, our strategies have a lower win rate and drag our win rate down. Therefore, if all we simply do is avoid the low probability days and no one were here to preserve capital, automatically our win rate will go up. So let's even take a look at this just to show you that I'm not just making this crap up. I already got NQ pulled up here. We can see I'm looking at Wednesday, March 18th. Here is the FOMC statement. The blue lines are weekly open, or excuse me, midnight open and 9:30 open, I believe. And then this vertical line is the 9:30 open. Now I trade ICT and I trade inversions and breakers, mostly inversions, fair value gaps. But what we can see here is relatively sideways price action. We create this opening range from, here to here, and price really doesn't want to leave it. Was there a short in here? Well, if your bias was short, yeah, possibly. There was a short here. But one other thing I want to point out for like how I trade, that would have been a brutal trade to have gotten into. And my stop would have been more like somewhere up in here, or even less than that. So I could have possibly been stopped out on this setup right here, this short. And what we can see in FOMC, price goes sideways, and price likes to make deep retracements and then expand and do nothing. And then it has these random expansions, like right there, expansion, do nothing. And that is not high probability price action. So here is Wednesday morning prior to FOMC. Let's go back here, and I'm going to turn on the sessions indicator so we can kind of see some sessions. So here's London. Here's Tuesday Asia session. And what we can see here, 9:30 open. This is the New York AM session. And it just blasts off and then just creates a range and doesn't do anything. Lunch is in a range and doesn't do anything. Afternoon session is in a range and doesn't do anything. It just kind of keeps hunting lower. It keeps building up this trendline liquidity that traders going to try to target and not going for it, right? This is not high probability conditions. So let's go to the next day, the Monday, and here is Tuesday morning, London. Here is Monday evening, Asia, and let's look at the PM session here. So even the PM session, you get this like massive explosive move up, explosive move down. So we have a manipulation of buy side. And then it kind of just doesn't do anything. Like if we look at this, if you took this as a short setup, right? Maybe you're doing something like this. You're anticipating even just a 1-to-1. Like it doesn't even give a 1-to-1. How terrible is that? The lunch. So look how, if you took this inversion here as a lunch trade model, it really didn't even sweep liquidity down here. So it's not like an A+ setup, but if you took this inversion, it just doesn't even move. So let's look at this long right here. I would have shot for these equal highs in 2.5, and I would have gotten maybe a little bit of a partial if I would have taken it, but look how slow it was to confirm above that inversion. And then of course the 9:30 open here, we just had sideways price action, a close above. There's no real inversion. Look at the volume imbalances in these candles. It just looks a little bit like Braille, like this isn't clean price action. And then there's an initial shot up at 9:30. What we can see is it shoots up and just does a super deep retrace and kind of just starts grinding up all morning long. Like imagine if you were in a long all morning. This is not high probability price action. So what does this mean? How do we translate this into something useful? Maybe some rules, because obviously I want you to go back test this, go look at this for yourself. But I want to show you the rules that I've come up with. So my FOMC rules are basically Monday, don't trade. Just don't do it. The data says I shouldn't even waste my brain cells in front of the charts. And that's actually a really good thing to talk about just very quickly is I've noticed that mental capital preservation is a real thing. And you can overexert yourself, wear yourself out on a Monday, and then screw yourself Tuesday, Wednesday, Thursday because you just had a bad Monday. And I know that doesn't make sense to newer traders or to traders that are struggling with self-control, but until you've seen it enough real time and in your own trading data, then you start to believe it, and then you start to like give up. You're like, fine, I'm just going to give in. I'm not going to trade because I know some people say it's low probability, and then you see it and you're like, wow, I feel good not trading today. And then you see Tuesday, Wednesday are green. You didn't take any other trades the rest of that week, and you ended up like up 3R that week. And you're like, wow, I worked very little this week and I'm up 3R. That's way better than grinding my way, out of a drawdown this week. So a little bit of a tangent. I digress. Back to the rules. Monday, don't trade. Tuesday, possible AM trade. Oh, that's supposed to say Wednesday, possible AM trade. No PM trading Monday through Thursday. So what I saw in the data here is that if you look at my notes, the PMs were always wicky and high resistance, one stage delivery, really not even worth trading. So PMs, I don't trade. So then the rules, 9:30 macro only. It has to be an A+ with momentum in equal highs or lows as a target. I'll show you an example. Reduce your risk by 50%. I think that's wise to do during this period, during FOMC week. It allows you to be in the markets because it's sometimes, admittedly, it's tough to go a week without trading, especially if it's like you're not on vacation or doing something else where you're like, literally, I'm supposed to be, the world, we were conditioned in a world where we work for dollars for hours typically to make the money. So we're conditioned, we need to be acting to make the money. And even as a business owner, you might not have a dollar per hour specific kind of like correlation, but you do have a productivity to profits correlation, right? And trading, when you're in the learning phases, there is that truth. When you're in the execution phases, it's not as true. Less effort can equal more profit. What am I trying to say? Sorry, is that I reduce my risk by 50% to be able to be in the markets to get through this week, the FOMC week. And I say 1 shot per day, max 2 trades per pre-FOMC. So that's just it, like 2 trades, 50% risk. It allows me to be in the markets because there could be a good setup. And that's what the data was showing, is that we had 1, 2, 3, 0.5. And this day's yellow because there was a questionable, maybe A- setup, but we still had a few setups, and I saw them, and I'll show them right here. And these were A+. So what you saw in the rules was A+ 930 macro. Has to have momentum, has to have equal targets. Now I trade inversions mostly. We can see there's this inversion here, swept liquidity, and we had equal highs in alignment with the bias, right? It gave the 2.5R, but we can even see how high resistance it was. And that's the other thing I noticed when I was reviewing all of this data, in these specific days is that if the model formed in between 9:30 and 9:40-ish, give or take a couple minutes after 9:40, it was typically the setup of the day, and then it went into high resistance and didn't go anywhere. And here's another example where we can see 9:37 a.m., maybe it might have been, because this says 9:36, so maybe 9:37. Inversion confirmed, took a long to these relative equal highs, and it gave that 2.5 R, and then it just did crap for the rest of the day. So those are A-plus traits. There is a lot of momentum to one side, a snap back to the other side. We can see a nice 3-candle formation on this one, 1, 2, 3. And this one had a few more candles, like a 5 or 6 candle formation, still pretty A-plus in my opinion. These might be worth taking. But ultimately, as I showed you with the P&L calendar earlier on, there are just some weeks that are meant for capital preservation. That is FOMC week. The next week will likely be, I want to say likely, I note this week as FOMC week is a capital preservation week. Therefore, I'm hopeful that the week after that will be a week for gains. So yeah, if you found that helpful, give me a like, give me a comment on the video, let me know. I'll be doing more of these kind of like nuggets. These are the things that I've learned from spending hours and hours, I mean, thousands of hours in the charts. I'm full-time behind the charts, and there's so much in my head I just want to get out and document and share. And these little nuggets, and what I like pointing people in a direction, and then like explore it for yourself, find the truths in it for yourself. So anyways, if that was helpful, give me a like, give me a comment. That would be super appreciated. A subscribe would be even better. I'll catch you in the next one.